San Diego Global Knowledge University.
Welcome. In this first part, we're going to talk about one of the most practical and powerful tools for entrepreneurs, the business plan Canvas. This model helps us organize and clearly see how a project creates, delivers, and captures value. With it, we can put strategic, financial, operational, and customer relationship aspects all into one simple plan. Throughout this session, we'll see how this canvas not only makes planning and decision-making easier, but it also strengthens the entrepreneur's vision. It gives them a complete picture that connects goals, resources, and chances in the market. Let's get started. The word canvas literally means lienzo in Spanish, which suggests it's a document of an unusual size. It's not a huge scroll, but think of it as a good-sized paper where you can clearly see a project's business model. A business model is how a project gets organized to create, give, and get value. In simpler terms, it's how a project figures out who its customers are and what they need, makes its products or services, and uses its skills and resources to offer something special that makes it different from others. It also shows how money comes in and goes out. Simple but a lot of work, it's definitely a concept map that neatly brings together 9 categories, which are 1. The unique value proposition. This shows the solution your project will bring and how it's made. It's the creative and clever part because the word unique is what makes your idea different from what's already out there. 1. The market segment or target market. It's super important to know who your customers are. You need to clearly define your target market because each group of customers has different tastes, likes, needs, and money, which makes them unique. 1. The communication or distribution channels. Here, you need to be very clear and explain how your product or service gets to the final customer. This includes any middlemen and their active role in the distribution channels. 1. Customer relationships. How your project connects with customers is really important. This can be online or in person, direct or indirect, door-to-door, through email, websites, regular mail, or directly in a store. It's all about managing customer relationships to have direct contact and get close to them, both to deliver your product or service and to get feedback to make your project better. 1. Revenue streams. This is one of the most exciting parts. As we've talked about, a project that wants to last a long time needs 2 things. A. It needs to make money. B. It needs to solve problems. So generating income means figuring out how the project gets money to keep going. You should include all possible ways, from crowdfunding, banks, investors, to sales, royalties, or any other income from daily activities. 1. Key activities. These are the things the entrepreneur knows how to do and does really well. It's like a list of strengths that help create value for the project. 1. Key resources. In a SWOT-like exercise, these are the things and elements the entrepreneur has to make the project happen. This includes tangible things like buildings, and also skills and talents, not forgetting any patents or special formulas they might have. 1. Strategic partnerships. Being able to team up is really important these days. Your project should be able to form smart partnerships with other companies, other projects, or other groups. This makes your project stronger and more secure. These partners give your project confidence. 1. And the expense sources. What do you spend money on to make your project happen? That's a key question that needs to be answered clearly and efficiently here. You need to do a careful and responsible analysis of the main costs your project will face, like royalties, rent, dividends, interest, as well as materials, travel, or any other important factor you shouldn't forget. These are the essential parts that make up the canvas, neatly organized into 4 big blocks that then break down into the 9 categories we just talked about. Finally, this is what a canvas looks like. It can be as big as the entrepreneur wants. It's a canvas divided into groups of information. In each group or section, you'll find statements that give an idea of the inventory, assets, or ways to run the business. and with that, make money and solve current problems. These statements are all connected to each other, aiming to make the unique value proposition even better. That's really, in short, what the company does, and how it does it differently, which gives it a competitive edge over others. Making a business plan needs a few steps, like these. First, you need to be super clear about your business idea or project. Second, you gotta do a market study to see what people need. This helps you figure out who your customers will be and how much they'd pay for your product or service. You'll also learn how to tell people about it, how to get it to them, and where to sell it. Third, there's the technical study. This part figures out all the costs for setting things up. It includes things like where your business will be, what equipment you'll need, the building itself, the technology, and anything else needed to make your product or service. Fourth, you'll do a production study. This looks at all the stuff you need to make your product, or if you're just selling things, all the items you'll be selling. If you're making something, you'll think about the materials, the people who will make it, and all the other little costs that go into making the product. Finally, the financial study. This is where you put numbers and money to everything. It shows how much it will cost to run your project and how fast it can grow. This helps you see if your business idea will make money and how long it will take to get your money back. So, the fifth step, you could say, is all about the numbers and money side of your business plan. This part is super important because it helps you figure out how much money you need to start your business. This includes the initial investment, the money you need to run things day to day, and any costs before you even open. It also puts together all your financial info into big reports like the balance sheet and the profit and loss statement. Here are some parts of a financial plan. Required investment. Besides figuring out how much money you need, you also have to decide how you're going to get that money. This means figuring out where the money will come from, like your own money, investors, or banks, and how much each source will contribute. Required investment. The money you need to invest before you even start your business can be put into three main groups: working capital, fixed assets, and pre-operating expenses. Working capital. This is the money you need to start making things. Investing in working capital means investing in things like initial cash, inventory, and money owed to you. These are all current assets. This money lets you operate for one production cycle. It makes sure you have enough money to buy raw materials and cover your operating costs until you get your cash back. This is called the cash cycle. Produce, sell, collect money. This way, you can invest it again. You can figure out how much initial cash you need by doing a market study. This helps you understand how customers pay, how suppliers get paid, and what your expected monthly sales will be. Fixed assets. This includes investments in things like machinery and equipment, furniture, vehicles, buildings, and land. Pre-operating expenses. These are all the investments you make in services or rights you need to get your project started. The main things here are organization costs, patents and licenses, startup costs, training, and unexpected expenses. Estimating cash flows per period. To estimate cash flows, you need the following information. 1. The project's useful life. 2. Income and expenses. 3. Depreciation. 4. Any extra investment for the project. You also need to figure out your financing needs and how much credit is available. You'll also need to determine the lowest acceptable return rate for each amount invested, your own money, financing, investors. When we look at this, we consider the project's profitability and risk, as well as other important factors. All these things come together in the financial statements. These documents help us put all the information into numbers, and then we can use financial tools to see how profitable the project will be. Financial statements. Balance sheet or statement of financial position. The balance sheet is a financial statement that shows how a company is doing on a specific date. It's like a picture of the company at that moment. The balance sheet would look different on another date. This financial statement is a snapshot and doesn't tell you what the future will look like. The balance sheet shows how assets are divided and the business's structure. This means whether it relies more on fixed assets or current assets. This is important to consider when looking at a particular industry. For example, some businesses are built on fixed assets, meaning a lot of their investment is in valuable fixed assets. Income statement or profit and loss statement. The balance sheet is different from the income statement. The income statement covers a period of time. It's the result or a picture of a specific period. The income statement is a financial statement that shows how the company is doing in terms of money coming in and money going out over a set period. Depreciation expense. This is an expense that the government allows, which gives you a tax benefit. It's meant to account for the wear and tear on fixed assets that lose value over time. It doesn't actually involve spending money. This expense lowers the amount of taxes you pay, which helps the company save money to replace the asset after it wears out. The problem is that this saving often doesn't happen, and the money gets spent on other things. Amortization of deferred expenses. This refers to money spent that isn't working capital or fixed assets, but it's essential to get the business going. For example, research costs, startup costs, and renovations. The government lets you recover a benefit for these investments through amortization. So these expenses aren't all charged in the period they happen, but instead, they're spread out over a period of at least 5 years, depending on how long the project lasts. This way, the cost of the investment is divided by the number of years to amortize, and a portion is charged to the period's costs each year, which reduces the amount of taxes you pay. Financial expenses. These are the interest payments on your financing. This is a super important part of how the project develops and how it's managed. These expenses depend on the decisions management makes, how much to finance and how to do it. Sometimes business losses aren't because of how the business operates, but because of how it's financed. As they say, some businesses are great, but they're financed poorly. Taxes. This is the money you pay for taxes. This amount is figured out based on your profit before taxes. Finally, these elements will let you use them once the cash flows are put together. And then you can use the economic and financial evaluation indicators, like in this case, IRR. Internal rate of return. The project's IRR should be higher than the weighted average cost of capital. The investor's IRR should be higher than the project's IRR. NPV. Net present value. The project's and investor's NPV should be positive. A positive NPV means the company is creating value. This will show if the project will be successful and make money over time. It's important to note that for organizations that provide social funding, sometimes they only need a cash flow plan and don't require a detailed economic evaluation. In conclusion, to do a financial study, you need to find the things in your business plan that require a financial investment. These include things like working capital, fixed assets, and pre-operating expenses, all put together into official documents like financial statements. The Value Proposition Canvas. The Value Proposition Canvas is a way to show things visually. It has 3 parts. The customer profile, which describes what a certain group of people is like, and the value map, which shows how you plan to create value for that customer group. The third part, called fit, happens when these 2 parts match up. The customer profile lists the tasks, frustrations, and gains of a customer group in a clear and detailed way. Tasks. These are the things customers are trying to get done in their personal or work lives. Frustrations. These are the problems or difficulties customers face when doing those tasks. Gains. These are the good results customers want to achieve or the specific benefits they are looking for. The value map, on the other hand, describes what a specific value proposition in a business model is like. It's made up of products and services, pain relievers, and gain creators. Products and services. This is a list that a value proposition is built around. Pain relievers. These explain how products and services help with customer frustrations. Gain creators. This describes how products and services make customers happy. The model fits when the value map matches the customer profile, meaning the products and services create pain relievers and gain creators that line up with the customer's important tasks, frustrations, and gains. Value propositions can involve several people in finding, checking out, buying, and using a product or service. For example, think about a family that wants to buy a game console. In that situation, there are differences between the buyer, the person who influences the purchase, the decision maker, the people who use it, and even those who might try to stop the purchase. So it makes sense to create a value proposition canvas for each person involved. Also, think about how a product or service is sold. If it goes through a middleman, you actually need to please two customers, the final customer and the middleman themselves. Without a clear value proposition for the middleman, your offer might not reach the final customer, or at least not with the same impact. Let's see how this model works with a simple example. Imagine the owner of a movie theater chain wants to create new value propositions for their customers. They might start with what they think an ideal value proposition looks like and get excited about fancy, new large screens, cool technology, tasty snacks, social events, art shows, city experiences, and so on. But all of this would only matter if customers actually cared about it. The theater owner would be wise to get real and try to better understand what customers truly want. Traditionally, they would have made demographic profiles of their customer groups, but this time, they decide to add to that kind of grouping with profiles that highlight customers' tasks, frustrations, and gains. The value proposition canvas is like a partner to the business model canvas, which you might have heard about in the book Business Model Generation. The Business Model Canvas is a tool that helps businesses figure out how they create, deliver, and capture value. The value proposition canvas is a smaller part of that, and it helps us really dig into the details of how we create value for our customers. Customer profile, customer jobs. These are the things your customers are trying to get done in their work or personal lives. They could be tasks they want to finish, problems they want to solve, or needs they're trying to meet. Make sure you look at these jobs from your customer's point of view when you're researching them. What you think is important might not be what your customer is actually trying to solve. Not all jobs are the same. Knowing the difference between these three types will help you think more openly and create a better profile of your customers. Functional tasks. These are tasks where your customers are trying to do something specific, or more generally, solve a problem. For example, at home, your customers might want to mow their lawn or try to eat healthy. Or at work, they might need to write a financial report or help their own customers reach certain goals. Social tasks. These are tasks where your customers want to look good, gain power, or improve their status. They're all about how they want others to see them. For example, as shoppers, your customers might care a lot about how they look and want to be trendy. Or they might want to be seen as good at their job. Personal or emotional tasks. These are tasks where your customers are looking for a specific feeling, like wanting a better quality of life, feeling good about their investments, or feeling secure in their job. Don't make the mistake of only focusing on functional tasks when you're creating a customer profile. Sometimes, the social or emotional tasks are even more important than the obvious functional ones. It will also help you create your customer profiles if you think about the tasks they do and how involved they are. This is super helpful when you're trying to group different types of customers. Let's think about these customer profiles. Value buyer. These customers do very specific tasks, like comparing deals, deciding which products to buy, waiting in line to pay, finishing a purchase on a website, or choosing to have a product or service delivered. Value co-creator. These customers do tasks that involve working with your company to create value. For example, think about customers who want to post reviews and comments about your products online, or people who want to help design your products or services by sharing ideas or joining discussion forums. Value transfer. These customers do tasks related to the end of a product's life, like canceling a purchase, getting rid of a product, giving it to someone else, or selling it again.
San Diego Global Knowledge University, education beyond boundaries.